Good morning, everyone, and welcome back to the Daily Hunt from Multibaggers. It's Monday, November 3rd, 2025, and we're ready to kick off the week with some fresh market commentary.
That's right, Ethan. We've spent the weekend, well, actually, our AI models have been sifting through a substantial amount of data, analyzing posts and discussions from Sunday, November 2nd.
And let me tell you, there was a lot to chew on this time around. We saw a decent number of companies flagged across various sectors, and the overall sentiment, it feels like a real mixed bag. There's some cautious optimism out there, but certainly a healthy dose of skepticism too. Let's jump straight into it then. First up, we have AMD, Advanced Micro Devices. Now, while we didn't get a direct flood of user sentiment for AMD itself, the discussions around related companies like Poet often mention AMD as a success story, a benchmark for growth in the AI chip space.
That's fair, Ethan, but we can't let indirect sentiment color our judgment too much. Look, our AI-generated insights indicate high growth expectations with elevated risk for AMD. Their PE ratio is sitting at an eye-watering 154.29. That tells me the market has already baked in an astronomical amount of future growth.
Well, sure, Brooke, but the news headlines are incredibly bullish, They're saying AMD's stock could soar, even outperform NVIDIA for the next 3 years. With AI heating up, AMD is perfectly positioned. Their next earnings report is tomorrow, November 4th, and that could really confirm these expectations.
It could, Ethan, but here's the thing. Current operations are showing a negative operating margin of negative 0.1275, meaning they're not making profit efficiently from their core business right now. And a debt-to-equity ratio of 6.513 is quite high. They've been on our stay-away list a lot recently, including last week. While the growth potential is there, the current financials suggest it's a very speculative bet at this price.
I see your point. It's a high-stakes game.
Exactly. So for AMD, our AI-generated insights suggest stay away.
All right, moving on to something a bit different, Cheniere Energy, or LNG. Now, this one's interesting because the user discussions were actually raving about ABAX technologies and their new physically delivered LNG contracts. That's a huge positive for the broader LNG industry, in my opinion, signaling robust demand.
And that broader demand could certainly benefit a major player like Cheniere. From a KPI perspective, Ethan, LNG looks quite compelling. They have an excellent net profit margin of over 21% and an operating margin of 41.20%. Their return on equity is exceptionally high at nearly 50%, showing real efficiency. Plus, their PE ratio is a relatively low 11.84, suggesting it might be undervalued given that strong 19% revenue growth.
Exactly. We're seeing strong profitability, solid growth, and a PE that's not stretched. Combine that with news about oil prices edging higher and the energy transition stalling, which means continued demand for natural gas, this looks like a prime candidate for long-term growth.
My only significant caution here, Ethan, is their very high debt-to-equity ratio of 228.13. While their strong profitability helps manage it, that level of leverage always introduces risk. However, the overall picture of strong fundamentals and a supportive market does outweigh that one concern in this instance. This stock has never been mentioned on the podcast before, so this is a fresh look.
Agreed, Brooke. For Cheniere Energy, or LNG, the AI-generated insight is a buy. Next up is a Titan, NVIDIA, or NVDA. User sentiment? Well, it's overwhelmingly bullish. People view NVD as the gold standard, a company with a monopoly on AI tech, continuously scaling and outperforming. If you missed out on prior tech booms, people are looking at NVD as the one that keeps on giving.
I get the excitement, Ethan. Their KPIs are undeniably impressive. 55.6% revenue growth, a net profit margin over 52%, and an astounding 109% return on equity. They're a money-making machine. But, and it's a big but, the valuation is in the stratosphere. A PE of 57.8 and a price-to-book of 49.23 mean that virtually all future growth is already priced in. There is zero room for error.
But they're delivering, supplying over 260,000 Blackwell AI chips to South Korea. That's real, tangible demand.
Right, but consider the headwinds too. News about potentially zeroing out China revenue and former President Trump's comments on restricting access to AI chips introduce significant geopolitical risk. And Qualcomm's entry into the AI chip race suggests competition is heating up. While NVIDIA's performance is stellar, the extremely high valuation combined with these emerging risks makes it very, very risky for new money. We've actually shifted our stance on NVIDIA quite a bit recently, moving from buy or cautious buy to stay away in late October, though we did briefly touch cautious buy again on November 1st.
That's a fair warning. It truly is priced for perfection. For NVIDIA Corporation, NVDA, our market commentary suggests stay away. Let's talk about POT Technologies, POET. Now, the user discussion is, well, it's really enthusiastic. People are calling it the photon dealer that everyone's missing, citing its photonics technology for AI data centers, recent capital raises, and even a $5 million production order. Many users are saying they're all in.
I hear the optimism, Ethan, but the KPIs tell a very different story. POT is currently deeply unprofitable. They have a net profit margin of 0, negative earnings per share of negative 0.81, and a deeply negative operating margin of negative 32.6185. This is a company that's not making money from its core business right now.
But the $150 million direct offering, the $75 million private investment, and that $5 million production order, these are real catalysts. They're moving from a science project to a revenue story, and institutional investors are clearly seeing something there. This company was on our stay away list recently, but with these new developments, that could change the game.
It could, Ethan, but these are still very early stage developments for a company with a PE ratio of over 11 and an exceptionally high debt-to-equity ratio of 14.84. The market is valuing it based almost entirely on future potential. This makes it an incredibly high-risk speculative play. We've classified POT as stay away multiple times in the past and even speculative gamble once or twice. While the news is promising, the fundamental financial weaknesses mean the risk-reward is still heavily skewed against investors looking for stability.
All right, I get it. High hopes, but serious underlying challenges.
Precisely. For POT Technologies, Inc., our AI-generated insights suggest stay away.
Now a big one, Meta platforms, or Meta. We had several discussions this week, and the sentiment was certainly mixed. Some users were panicking, saying, "How fucked am I?" But many others saw it as a massive buy-the-dip opportunity, expecting a quick rebound and highlighting Meta's fundamental strength and growth.
It's true there was a lot of back and forth, Ethan. Some users even adopted a contrarian bearish view, thinking retail enthusiasm meant a short-term drop was imminent. But when we look at the KPIs, Meta still boasts impressive revenue growth of 26.2% and a strong net profit margin of nearly 31%. Their PE ratio of 28.65 is also quite reasonable for a tech giant with this kind of growth.
Exactly. This is a cash cow, Brooke. Despite the dip we saw in late October, which some attributed to non-cash accounting adjustments or headline scares, the underlying business is rock solid. People are talking about Meta joining the $3 trillion club, investing heavily in AI and VR, and eventually that's going to pay off big.
That's the hope, and it's backed by strong profitability metrics. However, one data point that caught my eye across multiple analyses was an exceptionally high debt-to-equity ratio of 26.311. For a company of Meta size, that's a significant financial leverage that needs careful monitoring. Plus, there are legitimate concerns about an AI product problem and the AI spending crisis mirroring past metaverse risks. While the fundamentals are strong, these factors introduce a layer of elevated risk. Meta has seen a lot of back and forth on our ratings, moving from buy to stay away and then cautious buy just last week on October 31st.
Given the mixed signals, a degree of caution is definitely warranted.
For Meta Platforms, Inc., Meta, our market commentary suggests a cautious buy.
Last but not least, let's talk about Robinhood Markets, Hood. The community sentiment here is overwhelmingly bullish, Brooke. Users love the interface, they see immense growth potential with new products like the Gold credit card, and they're talking about it hitting a $1 trillion market cap by 2030. They even mentioned a very positive earnings report coming up on November 5th.
Ethan, I acknowledge the enthusiasm and their strong revenue growth of 45% and a phenomenal net profit margin of over 50%. Those are stellar operational numbers. But, and this is a significant but, the valuation is extreme. Its PE is 74.51 and its price to book is 16.15. These are very aggressive multiples, suggesting immense future growth is already priced into the stock.
But it's near its 52-week high, and the stock has soared from its 52-week low. That indicates incredible momentum and investor confidence. This is a disruptive company, Brooke.
It's certainly disruptive and has momentum, but it also comes with high volatility, indicated by a beta of 2.43 and a very high debt-to-equity ratio of 161.17. While the future holds potential for a $1 trillion valuation, as you say, investing at these current valuations requires flawless execution and assumes no hiccups along the way. Any slight miss on their aggressive growth targets or a broader market correction could lead to a significant downturn. We've classified Hood as stay away as recently as November 1st, so this is a continued stance.
It sounds like the market is very, very excited, but perhaps a little too much so for new investors at this price point.
Precisely. For Robinhood Markets, Inc., our AI-generated insights suggest stay away.
Well, that wraps up our detailed look at today's hot leads. A very interesting set of stocks indeed.
Absolutely. For those of you looking to dive deeper, here's our compiled list of candidates from today's analysis. Investigate as buy, Generic Energy Incorporated, LNG. Investigate as cautious buy, Meta Platforms Incorporated, MET. Investigate as speculative gamble, NVIDIA Corporation, NVIDIA.
And that's all the time we have for today's daily hunt for multibaggers.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in, everyone. We'll catch you tomorrow for another hunt.
Happy hunting!